Hello and welcome to yet another session from AARO Academy. My name is Frederick Tito, a senior IFRS consultant at AARO. And for today, we shall give you an overview of IAS 28, that is investment in associates and joint venture. Our agenda for today. In our discussion today, we shall start with the objectives of IAS 28, where we shall explain why and for what reason this particular standard was brought about by the International Accounting Standards Board. Secondly, we shall look at the definitions. We shall be explaining some of the terms that are used within the standard and the meanings that are specified for them. Thirdly, we shall look at classifications. How does joint ventures or associates appear in your statement of financial position? How are they classified? Are they long-term assets or are they short-term assets? Fourthly, we shall look at the equity method. The equity method is the method that is used to account for associates and joint ventures. So we shall be looking at it, how is it applied step by step. Then we shall look at the exemptions from the equity method. As much as the standard gives us the equity method to be used for accounting for associates and joint ventures, certain times there are exemptions to application of this equity method. So we shall be looking at that. Then finally, we shall try to explain why we encourage you to register for our AARO Academy trainings, the benefits that come with that, and how we partner with you in your group consolidation process and your reporting process to make your financial reporting a non-event. Objectives of IAS 28. This particular standard was developed to prescribe the accounting for investment in associates and joint venture. In doing that, the standard sets out the requirements for the application of the equity method when accounting for investments in associates and joint ventures. From a scope perspective, IAS 28 is applicable by all entities who invest in joint ventures or associates. So as long as you invest in joint ventures and associates, you think about IAS 28. However, you need to note that associates and joint ventures are accounted for in separate financial statements in accordance with IFRS 10. So when you are doing your separate financial statements, you need to look for IFRS 10 and apply the provisions under IFRS 10. Now, let's look at the key definitions under IAS 28. The following key terms are used with the meaning specified. The first is the term an associate. This is an entity over which the investor has significant influence. Now, what we refer to significant influence, there is normally an irrefutable presumption that when you own between 20% to 49% of shares in a given company, then you have significant influence. The second term is a joint venture. Now, this is a joint arrangement whereby parties that have joint control of the arrangement have rights to the net assets of the arrangement. It is normally an irrefutable presumption, or it is assumed, that when you own 50% of shareholding in a given entity and the other 50% is owned by a third party or third parties, then you have a joint venture. Of course, there are some other factors to consider, like whether you have some agreements on how you will share or how you will run this particular entity. And those are the reasons why we invite you for our AARO Academy training on IAS 28, where we share with you, we dissect and look at joint ventures and associates and give you the salient features that you need to look for as you define these two things. So what about the equity method? This is a method of accounting whereby the investment is initially recognized at cost and thereafter adjusted for the post-acquisition changes in the investor's share of the investee's net assets. So there are some other definitions that are specific to control. Number one is joint arrangement, which is an arrangement of which two or more parties have joint control. So then what is joint control? Joint control is the contractually agreed sharing of control of an arrangement which exists only when decisions about the relevant activities require the unanimous consent of the parties sharing control. Finally, we have spoken about significant influence. Significant influence is the power to participate in the financial, and not only financial, also the operating policy decisions of the investee, but is not control or joint control of those policies. So in this particular instance, an entity that has significant influence will take part in the decision-making and policy decisions of a particular investee, but to the extent that does not give it the right that is assigned to joint control or what we call joint ventures. So now let's look at classification. How do we classify associates and joint ventures under IAS 28? Associates and joint ventures are classified as non-current assets unless an investment or portion of the investment in an investee, that is associates or joint venture, is classified as held for sale in accordance with IFRS 5, that is non-current asset held for sale and discontinued operations. So what do we mean here? Ideally, you are supposed to classify joint ventures and associates under non-current assets in your statement of financial position. And at what time can this change? When you finally decide to sell this asset, that is the joint venture or the associates, when you decide now to sell them or to dispose them off based on IFRS 5, non-current assets held for sale and discontinued operation, that is the only time then you change the classification of that investment.